Dear friends, welcome to PMS Insights. At the outset, wish you all a very happy and prosperous New Year 2021. The year 2020 has been a year of contradictions, where we have seen markets having delivered their best 6-month returns in more than a decade, at a time when economic activity sharply contracted and humanity witnessed the biggest challenges in a decade. While central banks induced liquidity globally could explain this dichotomy partially, we can't ignore that COVID seems to have fast-paced some of the structural changes both at macro and micro levels that could lead to broad-based, non-linear earnings recovery in the medium term. COVID for equity markets has turned out to be a cloud with a silver lining, as we have witnessed a deep cleansing across India inclusive. Be it in terms of resilient business models gaining market share, overhead cost reduction, deleveraging, improved capital allocation, all of it leading to a far more efficient private sector, which would ultimately get reflected in higher return on incremental capital invested. This, along with the recovery in growth, could mean that positive earnings surprises could continue, reflecting in further enhancement in broad-based equity market returns. However, we need to stay cognizant of key risks, including weaker than expected recovery in discretionary consumption demand, higher than expected inflation, leading to reversal of monetary policy and sustainability of margins as business scale up operations to normal levels. As we crystal gaze into the new year, a few interesting investment themes are emerging which could lead the markets ahead. The first theme is big getting bigger. Over the last 3 years, while we are seeing market share gain by larger companies in multiple sectors like financials, telecom, aviation, real estate, the trend has accelerated due to disruptions caused by COVID. We are witnessing more consolidation even in categories like electrical cables, tiles, batteries, retail, which could lead to higher pricing power and profitability for sector leaders. In our portfolios, we have been buying sector leaders across categories. Stocks like Bajaj Finance, Pidilite, Astral Polytechnic, PI Industries, Shree Cement, L&T are some of the stocks which could be key beneficiaries. The second theme is rise of domestic manufacturing. Indian manufacturing has stayed stagnant as a percentage of GDP over the past many decades due to a weak ecosystem and infrastructure. However, despite shortcomings, India has become a global leader in generic pharmaceuticals and in two-wheeler manufacturing. We believe that conditions are now ripe for success in these sectors to be replicated across other industries as well. The China Plus One strategy for the West and government incentives like PLI scheme, tax cuts and labor reforms could lead to the private capex picking up over the next few years, especially in the industries like chemicals, pharmaceuticals, electronics and consumer durables. Moreover, capital goods companies can be beneficiaries as industrial manufacturing picks up in the country. Across our portfolios, we have healthy exposure to these sectors. The third theme is cyclical revival in real estate. It seems that we are at the cusp of cyclical revival for the first time since 2013-14. This is led by lower interest rates, improving the affordability, coupled with stagnant real estate prices for the last 7 to 8 years. This has reduced the differential between mortgage EMIs and lease rentals. The government incentives like stamp duty cuts in Maharashtra and existing incentives for the first-time buyers are also accelerating this trend. Apart from this being beneficial to developers and financial companies, the revival in real estate sector has been critical for few ancillary sectors as well, like building materials and consumer durables. Few of the portfolio stocks which could benefit include financials like ICICI Bank, HDFC Bank, Bajaj Finance, and consumer durable companies like Bajaj Electricals, Johnson Control Hitachi, and cement companies. The fourth theme is digitization. Apart from the Indian IT services sector, which is a direct beneficiary of this trend, companies which have been investing in digital for the last few years have benefited both in terms of consumer acquisition and profitability. Few stocks in our portfolio which are beneficiaries of this trend include IT companies like Infosys, Persistent, Happiest Minds, and technology leaders like HDFC Bank, Bajaj Finance, strong digital platforms like Jubilant Foodworks, and telecom players like Reliance Industries and Bharti Airtel. The fifth theme is a resurgence of mid caps. Post the last 2 years of underperformance versus large caps, we believe mid and small caps are well placed to outperform their large cap peers. Q2 was the first quarter in several years wherein we saw upgrades in earnings forecasts across several industries. This, coupled with the fact that mid and small cap companies have higher financial and operating leverage, will lead them to outperform the large cap earnings growth over the next 2 years. Nifty companies are expected to compound earnings at 28% over FY21 to FY23 against 40% growth for the mid and small cap companies. While the mid cap index has begun outperforming Nifty by 5% over the last 1 month, we believe there is still room for valuations to expand. On a 1 year forward price to book basis, mid caps are still trading at an 18% discount to large caps. In the year 2018, this valuation had converged for mid caps and large caps. Across our multi-cap portfolios, we have been increasing exposure to small and mid cap segment. Few recently added stocks include Aztec Life Sciences, Happiest Minds, Alkyla Mines, Apollo Tripod, Praj Industries, and JTECT. Apart from the themes highlighted above, we continue to employ our extensive bottom-up research process to identify mispriced opportunities with special focus on companies with credible managements, healthy balance sheet, higher return on capital, and strong runway for growth. In innovation portfolio, around 90% companies delivered results either above or in line with estimates, and 10% companies have delivered results below estimates. As seen in the table, 6 of the top 10 stocks have outperformed the benchmark over the last 1 year, and the earnings growth outlook for the top 10 holdings is improving going ahead. Coming to the last quarterly results, the average profit growth for the portfolio was significantly ahead of the benchmark and 68% growth for the portfolio versus 12% for the benchmark. We have bought Honeywell Automation in the portfolio recently, and this stock has outperformed since purchase in the portfolio. Thank you.